I'd like to welcome you all to this Association of Americans Resident Overseas Tax 101 introduction to tax reporting for U.S. citizens resident overseas. Uh, as we do have another, if you saw the notices that were sent out by Aaro, there'll be a more in-depth seminar, I think it's March 20th, that will cover most of the changes in the law that from last year to this year, and what you have to look forward in the future, and some of the more complex issues facing tax reporting for U.S. citizens to the United States. But tonight, really, it's really truly an introduction. What is, who has to file tax returns? What does that mean? What do you put in your tax return? How do you go about filing it? Where do you file it, and when? As simple as that. And what are all these forms that we listed in the notices that we sent out? So my name's Tim Ramier. I'm a U.S. attorney and a French attorney. I've been practicing here in Paris for the last 22 years. And this is Norman Reuter, who's a tax professional, attorney, and also tax preparer here in Paris for the last 30 years. Oh, 25. I'm sorry. I didn't mean to add anything on there, Norman. And we're going to play a little Mutt and Jeff show for you. I'm going to start out and just introduce first who it is that has the responsibility to file and report on a tax return. And then I'm going to pass it over. I'm also going to speak a little bit about the bank reporting requirements that you've heard about probably in the news more than anything else in recent years. Then I'm going to pass it over to Norman, and he's going to speak specifically on what it is that you put in a tax return and how's that defined from the point of view of United States fiscal reporting. So who is it that has to file a tax return? Just about everyone. It's U.S. citizens or what they call U.S. persons, people that have basically referred to as a green card. And even if you're residing abroad for a limited period of time and you still have that status, you have responsibilities to file a income tax return. Because I get a lot of requests from clients, mostly from their children who were born in France, and specifically my experiences with France, but these rules all apply to U.S. citizens wherever they reside. Also, residents in the United States also have requirements to file if you have income there. But a U.S. citizen has to file a U.S., what they call a income tax Form 1040 return under certain conditions, which are how much income that you had in a given year, you just start out from the idea that they want you to report your income. And just to give you an idea of what those rates are, because like I said, I have the clients' children that come in and say, Ajahn, speaking in French, some of them don't speak English even, and you try to tell them, well, are you a U.S. citizen? Do you have a U.S. passport? You have these requirements and obligations towards the country of your citizenship because the United States taxes and their tax policy is based on what we call citizenship-based taxation, as opposed to residency-based taxation, which is what almost every other country in the world applies to their citizens. If you leave France and you go anywhere else, once you've fulfilled your tax obligations to the French Republic, you're free. Then your next residence, you find out whether you owe anything to them. But under the U.S. rules, and this has been since they initiated income tax in the U.S., the rule. So it's a very particular way. I think the only other countries are North Korea and Eritrea. So we're in not the best of company when it comes to these kind of rules. So if you have a U.S. passport or you were the child of a U.S. citizen born outside of the United States and you're not quite certain, the first thing to do is to try to establish whether you have U.S. citizenship, and then if that's the case, you will have this obligation to report your income. How that's determined is, first there's limits as to whether you have reporting requirements, and they call those filing status under the U.S. regulations. And so if you're single and under 65 years old and you made more than $9,750 in the, I'm going to just refer back to 2012, then you're required to file a tax return. If you're 65 or older and single, the rates go up, 11,200 and so on. Head of household is a special status that also has its own rates, $12,500. And in the U.S., you can actually opt to file when you're married. You can file separately. The French rule is a bit different. You have a requirement to file a joint return, but the U.S. rule, again, we have our own rules. So, but when you're a U.S. citizen residing abroad, quite often the U.S. citizen spouse prefers to file married filing separately. What does that mean? Do you have to file a return? If you make more than $3,800 in a year, you're required to report on a U.S. income tax return. So they have different levels to try to establish whether you have to report already. If you don't have income, say you're married to a foreign spouse, a non-U.S. citizen spouse, and they're the ones that are making the income, and you're a U.S. citizen, and you don't have any direct income of your own, then you should be able to be exempt from having to report your income. So those are the different kind of filing statuses, as single, married, filing jointly, married, filing separately. For example, married filing jointly, if you make income together less than $19,500, you don't file a return. As you can see, these levels are all very relatively low because that's annual income. So almost anyone that has worked in any given year will surpass most of these levels, and thus you'll have to file your U.S. income tax return as a U.S. citizen. Do you have anything to add just on that aspect, Norman, of I mean, is that clear to everybody? Yes.
No, I don't understand the difference between the first sum, you said 9,750, and this sum of 3,800.
Well, the 9,750 is for a single person under 65, and you're not using any exemptions except for yourself. In married filing separately, they put the rate very low because you could benefit from the exemption of using your spouse also in the filing, or the spouse may be filing separately just to try to. There's different means of trying to lower your income to have less tax to have to pay. So I assume that's the philosophy behind that. Yeah, that's how I understood it myself, because it is a little odd. But if you're married, I suggest you at least be honest about it, because yes.
You also mentioned that children of American citizens who have American nationality but were born abroad in France, even if they do not live in America, if they earn more than $9,750,
That's correct. It's citizen-based, and that's the ones, even the director, the tax attaché here in Paris, he calls those, like my daughter, one day she's going to grow up and she's going to go, what? I have to file in the U.S. If she ends up, I bring her there as often as possible. But you have a lot of those people who have they're completely detached. Their parent may have been fulfilling their requirements, but the child then shows up one day and their parent is getting a little older and they're starting to get more involved in their finances, and that's usually the point where suddenly they wake up and they go, oh, yes, I have a U.S. passport, but I've never declared any of my French income on a U.S. tax return. Just because you have a reporting requirement doesn't mean necessarily that you are going to have to pay tax. And we're going to talk about the different kinds of exclusions, and Norman's going to address those. But yes.
I want to mention something about minor children, dependent children. They have a lower filing.
That's right.
It's $1,000 in investment.
So that's, if you do have children or dependents, that you can take them also as exemptions on your tax returns, and they have lower. I don't know what that. It's $1,000 if the child has the investment income in excess of $1,000.
Child who's still living at home.
Okay.
A child who's still living at home and is a dependent child, a personne à charge, well, they would have to be a dependent child under the U.S. rules. They're still living at home. You're taking care of them, and they're a student and under 24. If they have over $1,000 of investment income, they have to file a return. Work income is higher; it's around $4,000. Well, if they're a dependent under U.S. rules, if they could be taken as a dependent, even if they're not, then they have very low filing requirements. $1,000 of investment income, or approximately $4,000 of work income. In some cases, the parent can. It's not quite that simple. There's a special form you have to attach for the children's income, and in some cases, depending on what type of income they have, the parent can declare the child's investment income on their return. But it doesn't actually go with the parent's income. It goes on a separate form that's attached to the parent's return.
Right.
So it's a little bit complicated.
Yeah, it gets. We were not really sure, since this was an introduction, we weren't going to get into the real details, but the underlying principle is if there are U.S. citizens and they are dependents, or even if they're U.S. citizens, usually if they're minors, you're going to be declaring them on your return, but there's special means of trying to integrate them into the return and the type of income that they might have. Now, what I'd like to do is, just before we move on into precisely what kind of income that is needed to be declared on the U.S. return, I just wanted to address some of the bank reporting requirements in what we call the FBAR, or the foreign bank account reporting. And because this, even though this isn't an income, it's an information return, it's just, it starts off as one page, and basically TDF 90-22.1. And this is one of the things that many Americans say, that you don't even have any income, but you have bank accounts. And you're still going to have the requirement to file this form. This form is filed with the Treasury Department, and rather than with your tax return, so it goes off in to a different address, and it's a report to the Treasury Department, not the Internal Revenue Service. This has been in effect since the 1970s, and basically, if you have a bank account or financial accounts in excess of $10,000 during the prior year, that account has to be reported. Or if you have, say, 5 accounts, each with $3,000 on it, those combined together have to be reported. There are very stiff penalties for not reporting this on your accounts. Yes. They say in the aggregate, but basically that means taking all the well, it's a little more than that. I'll just read you the thing, but I'm going to answer that question. You have to report a financial interest in, signature authority over. So if I was the treasurer of Aaro and I was able to sign checks, I would have to report the Aaro account because it does have more than $10,000 on it. And as a lawyer, with the bar, I have different accounts that I have signature authority over it, but they're not my funds. I still have to report those on the form. If you don't have the form in front of you, it basically gives the name of the bank, the address of the bank, the city, the zip code, the country, and the amount. The amount was initiated, was it in 2008 or was it earlier than that? It used to be that you only had to report, you didn't have to put in an amount. But they changed the rules basically sometime after the 9th of September 2001 to try to trace the movement of funds for terrorism, drugs, etc. The filing date, and we're going to address the different dates, but the filing date is June 30th. But it has to be received at the Treasury Department in Detroit, Michigan by June 30th, which means you have to send it on beforehand. What you have to do is you take your bank statements from the prior year and you pick the highest balance that was on the account and you stick that in the area where it says maximum value of account during calendar year reported. The type of account, bank, securities, or other.
In a bank account, your amount may vary every single day. So you just pick like...
Yeah, since it's just an information return, I mean, what I tend to do, if you can't determine it immediately, you add a little bit more on top. They're not taxing you on this form, but you try to come as close to the amount as possible. The penalty is for not reporting any single account is $10,000 per account, or 10%, I believe it is. But it's, you know, so if you got 100,000 euros on an account, $130,000, and it hadn't been reported, you're going to end up paying at least a 10% penalty. So far, I mean, this is the kind of thing that's alerted a lot of Americans to their obligations, because the IRS started doing a lot of marketing about reporting these information accounts, because they know there's 7 million Americans living overseas. They get 700,000 returns in a year. So, you know, what really alerted them was the big case on UBS, and so they started getting very gung-ho, changing the forms, you look on the IRS website or part of the U.S. Embassy website, it's all marked on there, so they now say, okay, you don't know it. You used to be able to have good faith negligence that you didn't know you had this requirement, but it's no longer the case. So it's a reporting requirement that you're required to report on an annual basis before the 30th of June. If the exchange rate is fluctuating, you can look on, well, what you do is you take it at the end of the year. If you look on the irs.gov site, they do have exchange rates. They have links to other sites that do exchange rates. But the most favorable right now is the one that the U.S. Embassy IRS has listed as, for 2012, it's 0.81.
Is
That?
use the end of the year rate.
Yeah, it's the,
0.7.
rather than 0.81, because,
0.81 is the average for the year.
okay, yeah. The one that they had, yeah, for the F-bar, it is the 31st of December or the 1st of January, whenever it was published.
And what's going to happen to people who haven't done this yet?
Well, that's why they
Th-
initiate.
That's the problem. We don't know.
Yeah.
For years and years, we didn't take this too serious. Maybe the first time someone you hear about it, you take it real seriously and file it, and then you'd forget about it 1 year, and then you'd file it late, and nothing would happen, and so you get a little bit more relaxed about it, and then maybe forget about it for a couple of years, and then come in and file one late, and you'd never hear anything unless you got a social security number wrong or something, and then you get a ream of paper back, and on the last page it would say social security number is wrong. But things have just gotten more and more strict over the years. The penalties are extremely severe. I'm not that familiar with the penalties, frankly, because I haven't seen anyone,
Neither
with
have I,
one
so-
exception, subject to penalties, because, in fact, I've never had anyone or seen anyone else in Paris here subject to those penalties. Actually, the intentional non-filing penalty is $500,000 or 5 years in jail maximum. And then a few years ago, they added this $10,000 non-intentional non-filing penalty or late filing penalty. And the IRS has become more and more strict, as you've heard on the radio, with the accounts in Switzerland and these new forms coming out that we have to file. And I am very concerned that someone is going to come running to me saying, "What is this? I was counting on you," with a $10,000 penalty. So I'm trying to, generally I don't file these things. Generally this is not the kind of information people give me unless we've made an arrangement ahead of time. They don't tell me all the movements in their accounts and so forth. So generally I consider it the responsibility of the taxpayer unless they want to ask me to do it. But I've done a list this year of all the clients, and I'm going to be sending out reminders to them because I just don't know when the IRS might start applying this penalty.
So if I didn't know about this last year, this is my second year here. So should I just start now?
Well, yes, I would suggest you do several back years, and you do a 6 back years is what they say, and you send it in with a letter saying, "I'm very, very sorry. I didn't know about this. I was at a meeting and where they were educating people on tax issues, and I just learned about it. However, all the income from these accounts has been reported on my tax returns." Assuming that's the case.
It does have to be, there's still the $10,000 amount, and only bank accounts that are not in the United States. It's not reported, just because you live abroad does not mean that you have to report your U.S. accounts on this form. It's solely for accounts outside of the U.S.
You report joint accounts. They have a section for joint. They have the first part 1 is for your name, address, etc. Part 2 is for separate accounts. Part 3 is for joint accounts. Part 4 is for accounts which are not your accounts, but over which you have signature authority of one kind or another. So you have to report it all, and you report the full amount of a joint accounts. Yes.
I'm certainly not an expert on this. I have a friend who works in banking regulatory, and apparently there's a law now that's requiring a lot of the foreign banks to report any Americans that have bank accounts there. So it seems like they're going to be able to make the link pretty easily.
That's a possibility. That law is gradually going into effect, or not going
no,
into effect.
it is in. It's been in effect since the first form. It's a different. This form for foreign bank accounts has been in effect, as I said, since the 1970s, and they started out at $5,000 on a foreign account, and they've only gone up to 10. And Aaro has sent a group group to lobby concerning these issues every year. And most recently, in 2010, there was a new law that came into effect, which is called FATCA, which is a reporting on foreign financial assets, which the form doesn't go to the Treasury Department. It's attached to your tax return. The legislators in Washington were lobbied by some members of Aaro to look at the form, because it said if you had a bank account that in excess of, or financial asset, that means a company, or if you have an interest in a company, if you have an interest in an investment account, if you have an interest in a bank account, this other form, 8938, which was mentioned in our email that went out, is this new law that you're referring to. And the lobbying effort was successful in that they raised the level up to $200,000 for a single U.S. citizen with an account or a financial asset outside of the United States, or $400,000 for a couple. So that law is in effect now. That reporting is in addition to this one, but it's attached to your income tax return, and it has to be filed at the same time with your income tax return. So the one doesn't negate the other.
I did this last year, and it's a nightmare finding out when was the highest. I mean, really just, it's extremely time consuming. Is there a trick to figure out?
Monthly statements.
Frankly, off the record here, I will admit that when I do them, I kind of round off a bit. I don't put 6,000,000. I round off so it doesn't look like I'm rounding off, but I kind of guess as close as I can. If you're a few $100s off, I don't think they're going to put you in jail for it.
So per month is fine.
I'm not going to commit myself, but I
Take
tell you,
the
when I
highest
do
balance
it,
you
when
can
I do it,
find,
I just
yeah.
get as close as I can without worrying about getting within a few $100s.
Yeah, that's right. No, if you have $2,000 in one account and $9,000 in another account, you're over $10,000 together, so both accounts have to appear. If you have a livret A that has 100 euros on it, it has to be listed here with its account number. And then you have another account that has your checking account, like a compte courant here. The bankers will sell you all those accounts, PELs and every other kind of product here in France. If each one of those, once you go over $10,000 with one account or all combined, you have to list every single account. That's why it's Aaro is doing their best to try to get our elected officials in the United States to take a little bit more attention to the impact that this additional reporting and how it's scaring people in Washington. But it's an uphill battle. They're listening, but we're 7 million, but we all vote in different states.
But
Last year was the first time the form came out
yeah,
for 2011 income.
yeah, last year was the last year. This 8938 form, that's the one they were talking about, where you basically got to reproduce the income from the foreign bank, the information from the foreign bank account form, and attach it to your tax return, plus some additional things. But that's one aspect of FATCA. The question that was asked before about foreign banks, that's another aspect of FATCA, in that some of the foreign banks in some countries may be reporting your accounts directly to the U.S. government under these new laws. It depends. I don't follow that so closely. I just tell people you've just got to get the forms done correctly. Then you won't have anything to worry about. Anything to worry about.
Is what do you call it, a retirement insurance type thing, is that?
Yeah, well, I think you have to report these things. some of those are a bit complicated, and I can't address all of it tonight, but almost all of these things you're going to have to report. I'm trying to remember about a perp. There was some, I think the question I was thinking about is, did we have to report the income? But I think it was pretty clear that you had to report the existence of the account on these information reporting forms, the foreign bank account form, the TDF, and on the 8938 that's attached to your return.
Did I understand correctly that 8938 last year was the first year when you had
Yes.
to file? And if you forgot to do that last year?
I suggest you do an amended return.
Yeah, because it is a complicated form. We're the first to admit, because you also have to indicate how much of that particular account or financial asset income was reported, and on what line in what part of your U.S. tax return. And it's not even easy for professionals to have to go through. I mean, we're trained to go back and forth and then reproduce that information, but it's a headache return, and Aaro has really done a great effort in trying to get the people in Washington to understand that they've got to do something, either raise the amount even higher or consider that U.S. citizens abroad that are long-term residents residing overseas, they should have some other form of exemptions. But we're not there yet.
And is the penalty the same for 8938, $10,000 if you don't file?
I believe it is $10,000. It's not the same penalty as for the foreign bank account form, but it's about $10,000, I think.
Yeah, the difficulty with all these forms is that we've seen very little enforcement by, even though sometimes we'll file 6 years of back forms for people, they, the only response you might get back is, oh, you didn't indicate the name of the bank properly. But so far, I mean, I can only knock on wood and say, okay, even the tax attaché here, he understands the issues, but when you've got somebody auditing it, the form in the U.S., a lot of times they're not going to be as sympathetic. So, yeah.
Just to understand, so it's 8938. If your assets are less than either 200,000 or 400,000, you don't have to file at all, or you just file on.
No, you don't have to file that form, but we're talking financial assets. That doesn't include real estate that you own outright. It's bank accounts, shares, insurance, every other kind of financial asset falls into that. So if you own your home through a company, then you have to report the value of the assets in that company.
Okay, but if you have assets less than that amount, you don't file that form at all.
That's correct. Yes. No, this is purely information reporting for your assets outside of the U.S.
Just to make things clear, if we are under 200,000, we don't have to fill in 8938.
That's correct.
We have to do TDF 90.
That's correct. If you're married, yeah, if you're filing a joint return as married, yes, it's $400,000.
On form 8938, if you look at part 2, number 4.
But that's for a resident of the United States that has an account in Geneva. You see, if you're a resident outside of the United States, they've made different rules for if you reside outside. If you reside inside, they want to know where you're keeping your money outside, and eventually that they'll verify whether that individual is reporting their income.
So if I'm working here in a company and I'm putting some money in funds which I'll get at my retirement, do I report it for this one?
It's a financial asset, yes. It's another issue that's being debated both with the tax attaché here, and that was brought up during the lobbying effort, that there are a lot of other financial products outside of the United States that should have equal status with an IRA, for example, that are tax-deferred retirement funds in the U.S. And you know, there are tax-deferred retirement funds here in France. But so far, the IRS doesn't acknowledge, or they don't recognize that. So we're trying to get them to come up with an acknowledgement that those products should be treated in the same manner as a traditional IRA or some other pension plan in the U.S. One country that has, and it was just a recent bilateral treaty between the UK and the United States, but they're really doing it country by country because each country has their own tax scheme, and these are big issues that have to be addressed. But for the time being, that has to be reported. And as I say, it's informational, but you need to report it if it's over those thresholds.
Does any 938 apply to standard real estate holdings?
What kind of real estate?
Just standard real estate holdings?
No, just if you just own directly your real estate, doesn't apply. But it does apply to things other than accounts. For instance, if you have stock in a closely held corporation, a corporation which is not coté en bourse, you know. If your brother started a small company and you invested in it, then you got to report the value of that stock. And there's a few other things like that you have to report.
Okay, well, we can come back to any questions that you might have on these bank reporting requirements. I'm going to pass it over to Norman now. He's just going to briefly run through the different kinds of income, what it is, and and deductions, exemptions, and what goes on a U.S. form and which form it is. He has his own outline.
Well, I'm not quite sure. I see a lot of faces here that I recognize. Yeah. And since this was Tax 101, I was going to go over very quickly a basic outline of how a tax system works. And I found that to be very helpful to people because tax is infinitely detailed. The devil is in the details, and the return goes on for miles with all kinds of little lines, and you wonder does this one apply to me? And it's very easy to get sort of glassed over. It just becomes words after a while. So please tell me if everyone's already been through this, but I thought I'd give sort of an outline of how a tax system works so that at least when we're talking about something that's complicated, you don't understand it that well, at least you know where we are. So that being said, when you're dealing with income tax, it's taxation of income. You report income. Now, at least for U.S. purposes, I'm a little bit strong. I'm quite a bit stronger on the U.S. side than I am on the French side. I've been practicing here for 25 years, but I did my studies in the U.S. as a tax attorney. So income is actually defined in the code, Section 61, and it gives a number of examples, but it's not limited to those examples. It includes interest, dividends, work income such as salary, self-employment income. There are a number of things which it does not include. For instance, if you receive a gift or if you receive an inheritance, under both U.S. and French law, that's not considered income. That's considered an exchange of capital. So that would not be reported on an income tax return. And so you report income when you're doing an income tax return. Pensions are income. Pensions, alimony, unemployment compensation that one receives. What you receive which is defined as income either in the Internal Revenue Code or in the Code des Impôts in France. And it's basically what you think it is, but there are a few differences. Like I said, about a gift you receive from somebody, the code wouldn't, they don't have to write it that way. They could have said that's income too, and there may be some countries which say that, but I'm really only aware of the US and French systems. And it's defined that, well, if you receive a gift, that's not income and you don't have to report it. At least you don't have to report it and pay taxes on it. Actually, if you receive a gift from foreign sources from outside the US or an inheritance of over 100,000 a year, in a particular year, I think it's actually a little bit higher than that now, but it used to be 100,000. You have to report that on an attachment to your tax return form 3520. Is that what it is? And
yeah, but just to go back to
yeah.
one of the big differences, for example, in France, if you're dismissed from employment. Quite often the French, it's called an indemnity, a dismissal indemnity. Well, it's not taxable because under the French rules, but in the U.S. it is part of your income, and that comes up quite often.
Yeah, that's one that comes up. In fact, I've got one I'm working on right now. You get an indemnité de licenciement. In France, that's considered damages. You lost your salary, so you get damages for it. Well, if you're getting damages for salary, that's salary as far as the U.S. is concerned. There's been numerous court cases, and they all come down on the side of the IRS. So unless what you're getting from your employer is for real damages, he destroyed your car or he threw you out a window or something, you're getting paid, reimbursed the doctor's fees or the fact that the forklift of the company smashed your car in the parking lot and you're getting the garage fees paid for fixing it up, that would be damages. But even things like emotional suffering, sometimes something that gets close to that, the courts will say, no, you get anything from your employer, it's going to be income except in very rare circumstances. So that's a difference between the U.S. and French system of how they define income. But in any case, most of you have a pretty good idea of what income is. There are a few special, unusual, exotic items, but so on an income tax return, we're reporting income. If you receive a gift or inheritance, you may have to pay gift or estate tax, droit de succession, donation, but that's something else. That's tax on capital, transfer of capital. Now, the way a tax system works is, first of all, that if they're going to have an income tax, they have to define income, which they have. And then they may allow some deductions. They don't necessarily have to, but they do. At least for U.S. citizens filing a regular 1040, there are deductions. So in order to arrive at your tax, after you've reported your income, then you get to deduct whatever deductions are allowed in the Internal Revenue Code, or if you're in France, in the Code des Impôts. And the most common are like the standard deduction, personal exemptions for yourself, spousal exemption, exemptions for dependent. What is it? $3,800 a year for $3,800 per dependent, or $3,800 for yourself, another for your spouse. Standard deduction depends what filing status you have. It's lower for a single person than it is for a married couple. And then there's some other deductions they allow in lieu of the standard deductions, which they call itemized deductions. For example, mortgage interest, gifts to U.S. charities,
medical expenses, premiums paid,
it's
complimentary.
a number of things.
There's a whole list. It fills up many pages.
Well, there's quite a few, but basically it's a number of things which are not related, which Congress felt that, well, people ought to have a deduction for this, that, and the other thing, and you can take that instead of the standard deduction. And there are a number of things, unusual things that one allows the code would allow as a deduction moving expenses in some cases, sometimes contribution to a U.S. retirement plan, an IRA, you get a deduction for it. There's a whole list of things, and it gets quite complicated. So anyway, in an income tax system, they're going to define income, and they're going to define what you can take as a deduction. And if it doesn't say you can take it, generally you can't. And so after you take the deductions, you arrive at taxable income. That's the income on which tax is calculated. Your income, gross income minus the deductions, and then tax will be calculated on that taxable income. Tax will be calculated based on various rates, which vary depending on your filing status and how much income. Generally, the rates are graduated. And so after you've got to taxable income, they calculate your tax. And then it doesn't stop there because, for a lot of people, because after they've calculated your tax, you may have the right under the code to a credit, a foreign tax credit or a credit for the child credit. Or what are some of the other credits? A dependent care credit for a nanny. The first-time home buyer credit, there's a whole slew of them, and some of them are complicated. And so then after you get to your tax, you got your credits. And after you take away the credits, you end up with the tax you actually have to pay. And so that's basically the way the U.S. income tax system is structured, and it's basically the way the French income tax system is structured. And no matter how complicated this is, no matter how difficult some things are to understand, it all fits into this structure. And for instance, if we start talking about the foreign earned income exclusion, you know, we're talking about deductions. The foreign earned income exclusion is a deduction against work income when you're living and working overseas. If we're talking about various types of do we have to report this or that, we're probably talking about income. If we start talking about how the tax is calculated, the percentages, we're down in the calculation. If we start talking about the foreign tax credits, or the credit for a nanny to take care of your children. We're talking about the credits here. And so no matter how complicated some of the, and numerous some of these issues are, it all fits into this scheme, and I hope it's helpful. I've seen it helpful for some people to have a basic outline of how a tax system works. Yes.
I read somewhere that the French asset tax, the impôt sur la fortune,
Yes.
was deductible on Schedule A of your U.S. taxes.
That is not an income tax. That's a tax on capital, by the way. So it doesn't fit into this system at all. It's like the estate tax and gift tax are taxes on capital. Now, is it something that we can deduct here as a deduction on the U.S. return? If we could, it would be in the itemized deductions. It would be a situation where you decided to take itemized deductions instead of the standard deduction. And it depends what asset it's levied on. I don't remember it as well as I'd like to, but for example, if you're paying the ISF and you own your home, I don't think it would be deductible. The part of the ISF that's levied on your home, I don't think it would be a deductible tax. On top of that, if it's levied on, let's see, I'm afraid I don't remember.
I personally advise clients to, you can deduct your French real estate taxes. There's a special box, but you have to opt to do itemized deductions. If you're subject to ISF, the capital tax, there is a box where you can indicate wealth tax in other taxes and put that in as an itemized deduction on your Schedule A.
I'm not sure I agree with that. You can't have a foreign person, you can't deduct a foreign personal property tax. Like in the U.S.
But we're not talking about foreign, we're talking about a U.S. person.
Deducting the ISF.
They're out of their principal residence residing abroad, yes.
It depends what it's levied on. Where we deduct it is on investment income as a cost of holding investment assets. For instance, if you have a securities account, we may deduct it as a cost of holding investment assets. But if it's levied on your home or on personal property, if you have jewelry or the value of personal movable goods, I don't think it's deductible in that case.
But it is on financial assets?
Well, you can deduct expenses which are necessary for holding financial assets, for collecting revenue or protecting financial assets, and in some cases we'll deduct it there. But what you should do is after the meeting, give me your email and I'll look into it and double check and send you a resume. But it's not deductible across the board.
You have to understand that you're trying to always, when you have a foreign tax, you're trying to basically put a square into a round hole quite often because everything doesn't work across the board. And if you just do decide that you want to deduct a certain item, whatever that may be, in your itemized deductions, you have to have come up with some kind of plausible reasoning behind it that would somewhat correspond to the same kind of reasoning that we use in the U.S. and that's in the U.S. tax code. So there is no clear-cut answer because
actually, I just don't remember. That's the problem.
well, but there is
I looked it up before,
Yeah.
and it was relatively clear to me regarding the ESF. In the past, sometimes I would just deduct it, and then there was a client that had a lot of it, and we wanted to double check, so we did some research and decided that a lot of it was not deductible. It depended what asset it was levied on.
No, that sounds much more plausible. But in most recent history, we did have something very specific that, in most professionals' opinion, should be deductible. That's CSG and CRDS in France. That now the IRS has come out and identified that, and it's on the IRS website, and it specifically says, I mean, at the embassy here, that those are not deductions. Whereas Bercy comes right out and says that even though they call them social, contribution sociale généralisée, because the word social is in it, the IRS has decided, well, this is an easy one. You can no longer deduct that, and quite often that can be an extremely significant tax. Bercy has come out and said on numerous occasions that it is an income tax. But again, it's one of those things trying to persuade the IRS to change a policy on a system that they don't really understand. Yes.
Yeah,
Norman,
well, we're working on that, and first of all, we were in the Court of Claims for 3 or 4 years, the United States Court of Claims, and what I was told, I'm not the lawyer of record there, but I'm working with him, and I was working with him at the time, and what he told me was that the judge put it in a drawer and there was no way to make him move. And so finally he got fed up and made an offer to settle, and the IRS accepted it, and the IRS allowed 40% of the CSG CRDS as tax credits. But we were not able to argue on the merits, and we didn't get any ruling. So after that case was completely final and the last papers were signed, we filed immediately again in tax court. And we're presently in tax court and filed a motion for summary judgment in December. In early December, the IRS is expected to answer in March, and then we'll have a chance to answer their answer right in the middle of tax season when I've got other things to do. And we'll see. But we don't know what the result will be. We hope we'll win. We think we have the better arguments, but it's tough going.
So when you report your French income to the U.S. government, do you say, here's how much money I made in France and here's how much I paid already in French taxes, and then that's like a deduction from your U.S. taxes, or?
What you want to do most of the time is you want to take a foreign tax credit if you have to report French revenue on your U.S. return and you paid French taxes.
But before you even get there, it's the type of income that's concerned. And if it's wages or earned income, as opposed to what we call passive income, which are interest, dividends, that you would receive from the passive investments or rents. If it's earned income, you have a foreign earned income exclusion. When I started out, I said, married filing jointly, you have an exemption of 3,000, or if you earn more than 3,800, you have to file a return. But say that you only earn $50,000. It's included on your form 1040. That if you haven't seen it, this is what it looks like. We were going to project it up there. But as what Norman was saying, you'll see if you just read through it, you'll see there's lists of every type of income and the types of deductions. And but there are special provisions for when you are working in abroad that exclude a certain amount of up to a certain threshold of income. I was just actually trying to search because the new rate, I wasn't quite certain whether it was 95. Okay, on this form 2555, this is what you would have to file, 95,100, that's what I thought, okay. No, on this, on page 2, so if you earn less than $95,100, you won't, and that's your only form of income. You don't have any interest from the bank or anything like that. That is excluded, but you have to fill this form out clearly, and you have to meet 2 certain tests. One is what they call the bona fide test, where you are be able to demonstrate that you lived at least a full entire year outside of the United States. Okay, that's the first section. You have to show where your residence was and answer those questions about your citizenship and nationality. And if you look down, you'll see it also, there on that same form, it asks you whether you have a requirement to file the F-bar. And you have to check yes or no, depending upon going back to that $10,000 limit. But once you, or if you are able to show that you have lived abroad for, I think it's a number of days, but basically 12 months that say go across this 2 years, so it's not January 1 to 31 December, then if you meet that test, you're eligible to have this exclusion. I'm assuming that most of you have resided in France or outside of the United States to meet the bona fide test. If you haven't, then you have to start counting the number of your days to see if you're eligible to have that amount excluded. So if you earn less than that, and I hope all of you earn much more than that, then this is what prevents you from having to pay any tax to the United States. Then you go back to what that's in the section on deductions, and say that you did earn more. Then you have to go towards the credits and say, how much tax did you pay to France or to whatever foreign country? Then the Form 116 addresses that, where you can calculate whether the amounts of tax that you have paid to the foreign country can be used as credits against any taxation in the U.S.
Are you talking about a work income or investment income? Okay, well, is your work income less than $95,000, your brut salaire? Okay, well, then you don't have to worry about the taxes. You just use the deduction, as Timothy was saying, to use the foreign earned income exclusion, and to deduct all your a deduction equal to your revenue, to your work income.
Yeah, so if you're single,
when you exclude all your income, you can't use the tax credits. You can't use both.
if you're single and you make more than $9,750, as I started out saying, you have to file a return. You have to report the income. But if you make less than $95,100 this year, because it goes up, it has been going up, and our legislators in the U.S. regularly threaten to take this away because they don't believe we're the best ambassadors of the United States. So you wouldn't have any income tax to pay. Anything under this threshold would be excluded. If you go beyond that amount, then you have to start looking at that other Form 116 to see if the amounts that you are going to be paying in tax that relates to the type of income, whether earned. If it's your earned income that's above this, you have to figure out how much of your tax that you're paying relates to that type of income. And any kind of passive income, the amount of tax that you've paid to the foreign entity, foreign government.
Is that the same threshold if you're married, filing jointly?
No, each individual is entitled.
Yeah, when you're dealing with work income and the foreign earned income exclusion, it's personal to you.
So it's basically for a couple, it would be.
If your husband is an American citizen working over here, he's not. Well, you're probably filing a separate return then.
Yeah, I'm filing separately.
Yeah, well then, let's assume all you have is this work income, and when you take your salaire brut and you turn it into dollars, it's less than 95,000, and you don't have any U.S. work days, you don't have any U.S. business trips. You would just, on the front of the 1040, you'd have your salary on line 7, and further down, line 21 or 22, would be a deduction equal to that, and your income would be 0, unless you have some interest in there.
Does that go before the deduction exemptions or after them?
Well, if you have work income, if you have salary, that's income, and that goes on line 7 on the front page of the 1040, the very first line on the column there. And then if you use the foreign earned income exclusion because you're living and working overseas, you have to fill out the form 2555 as an annex to show that you're entitled to the foreign earned income exclusion, and calculate the amount of the foreign earned income exclusion, and then that amount is carried over to line 21 on the front page of the 1040 as a minus number, as a deduction.
It says other income.
Right. And in that space there, you put form 2555, the space to the left.
Okay. The question I have is for those of us that are self-employed.
Sometimes it's useful to deduct your deductions. Let's say, first of all, when you're self-employed and you're using the foreign earned income exclusion, you use it against the gross receipts, not the net amount. And so if you say your gross receipts were less than 95,000, what is it, 95,100, you could just put down your gross receipts and not worry about deductions, and then fill out the 2555 that shows it was all earned overseas and you're entitled to the exclusion, and then put down the amount of the exclusion on line 21. Carry it over from the 2555, and you wouldn't have to use the deductions. However, when I do that, I usually put down at least a few deductions so that the IRS agent who's looking at it will know that you're not deducting the net amount. You're supposed to report the gross amount for the foreign earned income exclusion. And if you put down just a few deductions, that alerts them, this is my theory at least, to the fact that you didn't just sloppily go through it and put down your net amount and exclude it. You know, you could have $30,000 of self-employment income net, but maybe you had 100,000 gross. I put down a few deductions for that reason. And then also, if you have other income and you're taxable on it. Since 2006, they have this, they changed the law where in order to calculate the tax rate on anything which is not excluded, if you have interest and dividends and you're paying taxes on it, they add back in the foreign earned income exclusion to see what rate to apply. You still get the exclusion, but on your interest and dividends, which is not excluded, they add back in the exclusion to see what tax rate to apply to the interest and dividends. If you deduct your business expenses on Schedule C, that will lower the rate. And so that's what we do if it's worth the trouble, if there's enough involved to make it cost effective.
How do you categorize family allowances?
You mean allocation familiale? We don't report that. There's this provision in the U.S.-French tax treaty. It's not the only treaty that has that. Belgium has a similar treaty with Belgium, and Luxembourg. They have a similar provisions, and there's other countries that have provisions like that, but not all treaties. It says you don't have to report any kind of prestation de la sécurité sociale française. So if you're receiving French Social Security, even if it's pension, French Social Security, pension, CNAV, or the caisse de retraite complémentaire, you don't have to report those. It's like it doesn't exist as far as the U.S. return is concerned.
That's what I asked before, pensions, and you said that it was under income.
This is how a tax system works, is that you define income and the deductions.
Right, okay, but but yeah, but the difference is now you've moved on to another level, which is how does the tax treaty there's a tax treaty that the U.S. has with almost every industrialized country, and it's called the Income Tax Treaty Against Double Taxation. And they have specific provisions. Article 18 addresses retirement, and also there's been amendments to the treaty. The most recent one concerning income, I believe, was in December 2006, where it's the paying country is the country to whom you owe a tax liability. So if you are receiving French retirement income, you only pay to the French, not to the United States. Even if you want to report it on your form, you'll see on Form 1040, there's a place for pensions and annuities, and there's a box 16A. You can put it in there and then make a statement on the side saying that you received it, so that you're in good faith by showing that you reported it. But then on 16B, where it says taxable amount, you don't include anything, or you just include your U.S. Retirement income.
When you start in the French restaurants, you keep it after 8 years, and then you don't have to pay your high tax when you take it out. So let's say you start.
You don't pay any tax.
Oh, right, for the French.
That's right.
When you start taking out this money to live on it, is it considered income?
Okay, first of all,
alluded to it earlier.
you have to understand how assurance vie is structured. There's basically two types of assurance vie. There's assurance vie en euro, or also called assurance vie monosupport, which can only have cash in it. And then there's assurance vie en unité de compte, also called assurance vie monosupport, multi-support, in which you can have a cash account, and you can also have various types of securities. They're generally mutual funds which are created by the bank for this purpose. Now, if you have a cash in an assurance vie, be it an assurance vie en euro, which is a contract where you can only have cash in it, or a cash unit in an assurance vie en unité de compte, in either case, that is going to produce a certain amount of income every year, which is credited to your account at the end of the year generally, and becomes part of your capital, just like a savings account. A passbook savings account in the U.S. earns a certain amount of income, a certain amount of interest, and that interest becomes part of your balance. In France, they call it the effet de cliquet. It's not tap dancing. It actually has to do with the fact that in your assurance vie cash unit, your part of the earnings are credited to your account and become part of your capital. This has to be declared every year as interest, whether you take it out or not. If you have, if
As what?
as interest, has to be cleared as interest every year, whether you take it out or not. Whether you take it out is beside the point. The fact that there's an envelope assurance vie, an encadrement assurance vie, is pretty much neutral as far as the U.S. system is concerned. What do you have? Well, you went to a financial institution, you put cash in it, and you earn a little something every year on the cash. As far as the U.S. is concerned, it's you got to report the income. They don't have any special rules about assurance vie. Now, if you have assurance vie multi-support, assurance vie en unité de compte, and you have the usual kind of securities in it, which are French mutual funds created by the bank for their assurance vie clients, generally, almost always, those are going to be French mutual funds, which in the U.S. would be treated as passive foreign investment companies. And there would be no income until they are sold, or actually racheté. Generally, you can't sell them to a third party. It's the assurance vie company that buys it back from you. And then you have a sale, and that income, if you have a gain, we haven't had too many problems tax-wise because most people have a loss on these things. But when you do have a gain, then that gain for U.S. purposes has to be treated under very special rules for passive foreign investment company, which are relatively heavy reporting requirements, and where you're taxed at the highest rate, a flat rate, which is the highest rate in the code, in the Internal Revenue Code. They passed this law to discourage Americans from, partly to discourage Americans from investing in these things, but also because generally the French mutual funds, be they mutual funds that you've just bought and have directly in a compte titre or a securities account in France, or mutual funds that you have inside an assurance vie, en unité de compte, or inside a plan d'épargne action. These things generally do not pay dividends. You can hold them for 10 years and there's no income if you don't sell them. And then you sell them and you have a plus-value, a capital gain, you have income finally. In the U.S., mutual funds don't work like that. In the U.S., mutual funds are forced to distribute their earnings every year as dividends, and the taxpayers have to pay tax every year on what the mutual fund has earned. And the Congress found out that Americans were investing in foreign mutual funds which don't pay dividends. And so they passed this law to rattraper, to cover what the Congress felt they lost, and perhaps also to discourage Americans from investing in them. So French mutual funds, CCAV, Fonds Commun de Placement, is what they're generally. There's two categories there. The French banker will say OPCVM, but they consist of CCAV and Fonds Commun de Placement, FCP, and generally Americans should avoid those, in my opinion.
Assurance vie en euro is taxed at what?
On euro, what your earnings every year are taxed as regular interest.
Regular
Yeah.
interest. So the 8% or whatever that you're gaining on the French side, you'll be paying on the American side.
Depends what rate you're in the U.S. If you have very low income and let's say you have $50,000 salary, when you turn it into dollars and it's all excluded, and then you have $1,000 of interest from your assurance vie and livret A, well, you're not going to pay any tax because, as well as excluding all your work income with the foreign earned income exclusion, you still have your standard deduction, personal exemptions. For a single person, that amounts to $9,000 nowadays. So you could exclude all your work income and then still have deductions of $9,000 to deal with, get rid of any tax on investment income.
I'm living here in France solely on retirement income from the state of Oregon. So do I pay French income tax?
No. Since a few years, they've changed the treaty, and actually for American citizen, hasn't changed that much for most people. But if that's your only income, no, it's not taxable in France. Pensions are taxed where they originate nowadays, as far as U.S. and France are concerned. Same thing. However, if you have French income, it has to be declared on your French declaration to push your French income higher up the bracket.
It's not taxable. That's, as I said in response to this other lady's comment about the French retirement funds. The treaty treats the payor country as the one to whom you owe the taxing obligation if you have to pay tax at all on it, depending upon how much it is. Yes, sir.
How about CSG, CRDS on U.S. pension?
They're doing that as of 2011, the tax year 2011, which we filed last year in 2012. The rules have changed to apply CSG to foreign pensions if you're benefiting from a French medical Social Security medical coverage. However, before that, the rules already existed to apply the CRDS, which is only 1/2 of 1%, so it never amounted to too much. However, if you read the instructions to the Form 2047 on which you report the foreign income and where you would have to report your foreign pensions for this purpose, if you read the instructions, I think it's the last page of the instructions, I think it's Renvoi 17 or something like that. At the last line it says, this only applies if a treaty does not exclude France from taxing it. And in fact, my interpretation of this, and I think it's going to be accepted, is that since in France they consider the CSG and CRDS to be income taxes, they treat them like income taxes, then they fall under the tax treaty as income taxes. And the tax treaty says they can't tax the U.S. pensions. They can't tax them for impost sur the revenue, the regular income tax, and they shouldn't be able to tax them for CSG and CRDS either. I have a case going on right now. We didn't go to the Tribunal Administratif, but we went to the Conciliateur Départemental, and we're waiting for him to come back with an answer because there still wasn't very much involved. It's with the CRDS, when it was just the CRDS in prior years, clients would say, do I have to pay the 69 euros, you know? And finally I filed in the Tribunal Administratif in Paris here, just on principle. And we never got a judgment because they decided, the tax inspector decided, well, we'll just refund it. And then the case stopped. So we never got a judgment. But there was a reason for filing. It wasn't just principle. We wanted a judgment. And that was a good idea, even though we didn't get it, because now we've got the CSG as well, which the two of them together amounts to about 7%. Not just 0.5% anymore. So no, I don't think they're supposed to do that. But you'll have to deal with them, and you'll have to deal with the tax people. And if they don't accept your response, then you'll have to go to the Tribunal Administratif. We don't have a judgment yet.
Nearly every year, we get responses back for clients we file French income tax returns for when they have, say, just U.S. source retirement, and they in the mail they'll get their avis d'impôt, des prélèvements sociaux, and we have to systematically write back to the tax authority saying that no, this is excluded, and cite the provisions of the treaty, and cite a decision that was handed down by Bercy. I mean, it's practically a prepared response that I use every year, because there's always one or two places out of Brittany where the tax inspector in that office will send out the CSG and CRDS. So it's, you know, the message just hasn't got across that also applies under the tax treaty, and that it is excluded from
that's the
tax.
procedure you have to do, une réclamation. If they billed you, then you do une réclamation either before or after you've paid. And if they accept it, great. If they reject it, then you have 2 months to go to the Tribunal Administratif or to seize the conciliateur départemental. And we don't have a clear, a nice, easy-to-read judgment that we can send to the tax people and say, here, you're not supposed to do this. So we have to deal with it on a case-by-case basis.
Shall we talk about, you have another question here, but, well, yeah, that's what I'm actually going to do. I thought we would talk about the periods when you have to file and the different mechanisms on filing. So I wrote it up here. Basically on April 15th, all U.S. citizens or taxpayers that have to file a return are required to file on the 15th, or at least pay whatever tax that you've calculated that's estimated to be due, even if you reside abroad. You have to pay your tax by the 15th on the prior year's income. That said, when you do reside abroad, you have an automatic 2-month extension to file your return. So that April 15th deadline doesn't apply to us that reside outside of the United States. I mean, you still have to be able to demonstrate that you were outside of the United States on April 15th. I mean, we generally use a form that just a phrase citing the regulation, but it's quite a common practice. But you still have to include something, a statement on your return stating why you're filing 2 months late. But if you do have tax to pay, April 15th, it's due. Otherwise, there are penalties and interest can apply. Now, when you get to June 15th, and say you weren't able to get your foreign income information, your French tax return was filed on the 30th of May, or not until electronically until June, and you couldn't do your calculations, so you say, okay, I'm not going to be able to make that date, then you have to file this Form 4868, an extension to file that allows you then until the 15th of October to file your income tax return. So as opposed to the French, you have a little bit more breathing space, at least to try to go through this very obtuse process of filling out these forms. But those deadlines are very important to respect, because if you can be subject to penalties and interest. But generally, if you pay your estimated tax by the 15th of April, you can escape having to pay penalties or interest. Yes?
You made a mistake on your estimated tax because you didn't have all the information by the 15th of April.
Well, round it up then.
Round up.
That's, I mean, there's, until you get all your information and do your definitive calculation, it's a lot easier to take that extra time to do it correctly than it is to do an amended return once it's filed. And because that, I mean, it's another, you're practically doing another, you are doing a complete other filing when you have to amend a return. And that's where you start getting a little bit more entangled, because then there is an auditor that takes a closer look at amended returns. So if you get your forms in early, you have to understand they're very understaffed at the IRS. So what they tend to look at and audit are the one, the amended returns, and two, the ones that really owe quite a bit of tax, or now with all these banking requirements, those that have a lot of assets that may not be declaring a lot of income. So those are your dates there. And any other dates that we need to make everybody aware of? The 30th of June for the F-bar, and the FATCA form is just attached to your tax return. This is for the income tax return filing.
So if you're filing the actual 1040 and associated paperwork on June 15th, what form do you send in on April 15th?
You don't have to do anything if you reside abroad. You don't, it's automatic. But what you do by June 15th, if you're going to file on June 12th, you don't have to do anything except make a mention on the form that you're a taxpayer that resides abroad. You can be as simple as writing it across the top of the form. I mean, I tend to, like most of the other practitioners, attach a statement that cites the regulation, which, I mean, you can look it up on the IRS website. That I don't know the name of it off the top of my head, because, but
I'm confused. So you have to file by June 15th. But you don't have to pay estimated tax by April 15th?
no, but April 15th is the deadline to pay any tax that's due on the prior year's income. That's the end. That's your final deadline for that. But the only time they get a form that they could even try to figure out whether you paid properly, because there are some other dates. Now, so in 2013 this year, you have the other dates are to pay estimated tax. Okay, because the U.S., as opposed to here where they start taking based on the prior year, they actually send you a note in February, and when is it, April or July, and then in September they figure out finally after they've received your form. The U.S. bases your estimated tax in 2013 now, so by this year on April 15th, you have to pay any income tax that you would owe on 2012. On June 15th, but you have an automatic extension to file your return by June 15th. If you aren't going to make that date, then file Form 4868. It's just a small little sheet that just says, and it gives you an automatic extension from then on. I mean, it's not automatic, till the 15th of April to file your return. But October. Then, no, I know I'm getting to the estimated tax. So now this is the date for 2012. For 2013, they already want you to estimate your tax that you might owe and pay on June 15th an estimated portion of your 2013 income tax. Correct me if I'm wrong. And then September,
The first one is April 15th.
it's the April 15th is for the estimate.
First estimated tax.
Then June, September, in January. Okay, yeah, I was 2 months behind there.
However, not the estimated tax, if you have to pay more in April, you have to pay more
Right.
because
Yes, a balance due.
your balance due. But you're going to be using your extension, your automatic extension to file your form. Do you send in some paperwork with the check that you're going to send in for April 15th?
Um,
There's a
It-
voucher
it,
form.
it depends how much you have to pay. If you only owe $1,000, the interest rate right now is 3% per year. It's hardly worth the trouble. It's easier just to pay a few months of interest at 3% per year. It's peanuts. Um, uh, there's basically three things that run. There's interest, there's a late paying penalty, and there's a late filing penalty. The late filing penalty is the big one. If you have a balance due from 2012 and you don't pay it by April 15th, interest starts running from April 15th in any case. If you lived in the US, penalties would start running also. However, the automatic extension to June 15th that you get when you're overseas protects you against the penalties. So the penalties don't start running until after June 15th. From April 15th, if there's a balance due and it's not paid, it's just interest that runs. And then if you get to June 15th and you still haven't paid, the late paying penalty starts running. And if you haven't filed an extension or filed your return by June 15th, the late filing penalty starts running also. So basically, if you got a balance due from 2012, interest, and it's not paid by April 15th, interest starts running. And the penalties don't start running until June 15th.
But let's say I have a balance due that I want to pay on April 15th.
Right.
When I send in my check, what piece of paperwork do I send in?
4868.
When you say file, that means the postmark?
Um, when you're dealing with a payment, it has to be received at the IRS before they count it. If it's a filing date for filing, like the late filing penalty, the cachet de la poste fait foi. The French postmark is accepted for a filing date when the filing date is critical. But when it's a payment, it doesn't work. It's got to be received at the IRS.
But they have created some electronic filing. If you go on the IRS.gov site, you can sign up to do electronic payments as well. It's a little bit more complicated. If you don't have a bank account, you're going to need a bank account in the U.S. to be able to do that. So, I mean, there are complications. One of the ways that you can, if you have a payment that is due by the cutoff date, then you can go to the U.S. Embassy and say you want to see the IRS, and you go there with your 4868, your check, and a copy of that, and so that they'll put a stamp that received on that date. Now that said, the IRS is the office here in Paris does have a number of services. You can call them, you can ask them these questions, you can go in there still, but they're discouraging people to come to the office now, and because they want us all to do reporting online. And that was one of the things I wanted to address, that you're not obliged to file your return on paper. You can go onto the IRS site. They have a thing called e-file that allows you to be able to try to do your filing over the internet, over a secure server, and sign up to do payments. But if you don't have a U.S. bank account, it's going to be very difficult. So as Norman has said, if you have a payment to be made, you better send it in early enough that it is received by the date. The other thing is the FBAR forms can also be filed you can go on their site and sign up. There's some security questions that you have to go through, and then you can fill out the form online, just like you can fill out your 1040 online and fill out all the other forms that would be attached to your 1040. So the FBAR can also be filed online. It was a year ago that I attempted to do it, and it never worked. But so I haven't tried since. But last year it was that. But I mean, I have a tax program that also I can file directly from my computer, and it sends it to the IRS, and then I get an acknowledgement back. But they specifically set that up for individuals that want to try to do it on their own. It's a simplified form of doing your filing, but I personally haven't gone on in well, not in a year, to even attempt to do it again. But the facility is there, and the IRS is pushing everybody to do online. But if you get stuck in a pickle and you say, I want to make sure I don't have to pay any penalties or interest, then you can go down to the embassy. Don't take an appointment, because to get into the consulate today, you're supposed to sign up, and it may be 3 weeks before you do. For the IRS, you can usually go to the staff at the door and say, well, I just have an IRS form that I have to file, and they'll let you through. But they are discouraging at least us professionals to go physically there anymore, because it is difficult to get in to the consulate. Just some, I mean, we're kind of running out of time, but I just wanted to alert you to the kind of resources that are out there. One, the U.S. Embassy is out there. On March 12th or 20th, no, the 12th, the IRS has a tax assistance program that they're at the Mona Bismarck American Center, 34 Avenue in New York. That they started this last year to be where they're assisting people in actually filling out their income tax forms. Right, it is the 12th, isn't it? Okay, at what time?
From 2:30 to 5 o'clock. From 5:30 to 6, so for half an hour, there is a short presentation followed by a question and answer session. They will talk about new tax laws, but we will also be talking.
And it is free.
And that
Yeah.
is free. But they only do that for half an hour, so it's very.
It's kind of like this presentation, but we try to devote a little bit more time to it. So they do have, the website is very good. They'll answer almost all your questions. You can even get e-letters from them that send out notices on different issues on the www.irs.gov. You can find every single form on that site, as was indicated before you came. The other site that is very helpful, there's the france.usembassy.gov, where you'll find a slew of information. I don't know if that's the right word, but a lot of information concerning U.S. citizens on registering for your passports, for citizenship for children. Everything on taxation is right there. They have a form that they fill out with a lot of the information we've addressed tonight. I mean, that addresses that with links to the places on the IRS site, to forms and to exchange rates and these other things. And they also have lists of tax attorneys and accountants that can assist you if you require assistance. And those were the only resources I had up. Anything else?
There's also, maybe we should just open it up to questions.
Yeah,
Because-
we only have a few minutes left here, but wait, before question, okay, yeah, let's limit it. Go ahead. Yes,
Well, I'm just wondering, what are you advising for someone who really is never declared? And where do they start, and where does the IRS stand now on penalties and on amnesty?
but-
That one amnesty program was a joke, people were being killed.
Well, basically, you have to look at each person on a case by case basis. It's not easy when you're dealing with a well. It depends. There are some non-filers who say it's somebody who just had a small amount of work income and a couple of dollars of interest, a couple of euros of interest. Somebody like that, you can get them back into the system very easily. Other people who have a lot of income, it can be difficult. So you just got to do it. It's at a case-by-case basis, looking at all the facts going back many, many years for each person.
Generally, last fall, the IRS came out with a simplified, what they call voluntary disclosure program, but it's basically this. What they suggest is that you file 3 back years of income tax returns with all these forms, and the last 6 years of FBARs. It's obvious that they're trying to look to see if you had income in those banks and how the values have progressed over the years, and they'll compare those to your year's income tax returns. They still do have an open program for voluntary disclosure. My personal view on it is that you stand a much better chance in getting in on just filing the past 3 returns and your FBARs, and if there is a difficulty, they do still have due process where you can go to the tax court to challenge any undue penalties that they might levy on you. Then you can also even appeal above the tax court to district, and then so you still have the use of the courts. The voluntary disclosure program is very limited, and there's apparently a policy that they are not to negotiate. But many of those, that program was really set up to try to catch people with millions of dollars that they haven't been declaring. So,
So, sorry, you're saying it's better to contact this simplified voluntary program than to just file?
No.
no, I say file the returns, and then when the IRS comes back, you have somebody across from you that you can negotiate with and say, look, I've filed all my taxes in France. I've fulfilled my obligations. I was unaware of this, and I'm trying to be good and come back into the system. I wouldn't have paid any tax even if I had filed because of my exclusions and my credits. And I mean, that's my view is the better approach. As Norman said earlier, we have very few cases to be able to base an educated guess as to how they're going to respond to all the accidental Americans out there that didn't know that they even had these reporting requirements.
I'd like to just add one thing. I said it's a case by case basis, and there's a number of dangers to it, even for a person who doesn't have very much income. If you're in the situation like Timothy said, or where I said the example where you really don't owe anything, then it's not gonna be hard to get back into the system. Basically, you just got to file your returns. Often what we will do in a case like that is, for someone who really doesn't owe anything, they have a small salary and a very small amount of interest income, rather than even file the last 3 years' returns, often we'll just file the current year, and that's it. If you go to the consulate, they would say file the last 3 years' returns. But if you owe any tax at all, there are a number of tricks to it, and you basically need help to deal with that. You can lose the exclusion in some cases, the foreign earned income exclusion, if your returns are over a year late and you've never used the exclusion before. So that's a danger for some people, and there are measures which can be taken to protect them, but you have to know in advance before the IRS starts messing with you.
Or is it better just to ignore it for the rest of my life and take French citizenship?
And renounce your U.S. citizenship. Well, that's a personal decision to a great extent.
Well, would there still be
Anyway, I can't publicly say that it's better not to file your tax returns.
No, the IRS is very well aware, and that's one of the things that Aaro had brought to the forefront. That I'll just give you one example. One of the representatives in Washington was with American Citizens Abroad, another sister group of Aaro, and the American ambassador in Geneva came out and said in 2012 there were 900 renunciations of U.S. citizenship. In 2011, there were 450. So there, you know, all this red tape and the requirements that they're pushing on us, who all thought that we were good citizens, is having an effect on, and people renounce contre cœur. They do it. They, you know, I'd never want my daughter to ever renounce her U.S. citizenship. I don't ever want to have to do it, but I can see that some people are in a position where they may come to that decision, but it's a personal decision, but I haven't yet to meet. I have a lot of inquiries, but people just, you know, it's like pulling teeth. I don't encourage them, but even for them, they see the advantages of saying, well, I don't want my children to have to inherit this nightmare. And so we've gotten the number of requests for information concerning renunciation have gone up. Yeah, there's a presumption, I think it's over $2 million, that you're doing it for tax purposes, but it has come to a point where they are very well aware, and I was in Washington, and everyone that we mentioned this to said, please don't encourage our citizens. We obviously want to try to correct this situation, but they don't have an answer. So Aaro and some of these other groups have tried to offer the legislators an easy way to come up with a solution. Yes.
If you fall under the weight of the foreign earned income, can you still submit the foreign tax credit?
Are you saying that you have less than the maximum amount of foreign earned income exclusion? Your income is less?
Yeah, income is less.
No, if you're excluding it all, you lose all the deductions and credits that are connected with that income. You either get to deduct it or use the credits. Yeah.
Can you just say a word about how you treat mixed income? I mean, mixed French income and American income when you're filing your U.S.
Let me just add one thing to that, and then, Norman, you can answer that question. When you have first, I should have addressed this when I said who has to file. You have to have a Social Security number to be able to file. Otherwise, your return will be kicked back out by the IRS. So every U.S. citizen is entitled to get a Social Security number, but a foreign spouse, there's certain people that will not meet the requirements, and so you have to get a thing called an individual tax identification number for your foreign spouse if you're going to include the foreign spouse's income. I think that's what you're referring. No, not mixed. Oh.
You make some money in the U.S. and some money in France. You have dividends in the U.S., dividends in France, then you're filing a U.S. tax return as a resident in France. So how is that?
The way it Well, the exclusion only applies to work income. So your dividends, in your example, French dividends, you have to report them on your U.S. return. And if there's any U.S. tax on those dividends, then you can offset it with any French tax you may have on those dividends.
And U.S. income?
Pardon?
And U.S. income? How am I declaring U.S. income?
Well, on your U.S. return, it's just declared like you would declare it if you were back in the U.S. and you pay taxes on it.
So it's a separate line from...
No, if you, for example, you had U.S. dividends and French dividends, they would... Okay, earned income. Okay, you have some from the U.S. and some from France. You're living here. Well, assuming that's the case, you could use the foreign earned income exclusion only against the foreign income and the foreign tax credit as well if you're over the exclusion amount.
So I'm separate
On line 7 at the top of the form, at the first line on the column on the front page of the 1040, they would both go in line 7 added together. But then you would do a form 2555 and show the amount of the foreign work income. If you're talking about work income, it's going to be, and you're working in France, that's going to be foreign income, unless you're working through a partnership. But if you're working, you're getting a salary from the U.S., but you're working in France, or you're self-employed, and all. And your clients are in the U.S., and they send you checks from the U.S., but you're sitting here and tapping on your computer. That's foreign work income. If you're working in France, you're supposed to be paying your Social Security taxes in France and not in the U.S. And then you don't have to pay U.S. Social Security taxes. So this is U.S. Social Security self-employment tax, but you definitely need to attach a statement to your return, or a couple of statements. You have to, on the second page of the 1040, where has the line for the Social Security self-employment tax, I put a little note there, C attachment, and then I put a 0 in the column. And then I have 2 attachments. I attach the Schedule SE, where I write on it C attachment, and there's no numbers on it, just C attachment. And then I have an attachment that says taxpayer is exempt from U.S. Social Security self-employment tax by virtue of Article 7 of the U.S.-French Totalization Agreement. You have to have a statement which tells them you're exempt. And so they see it. And if they don't see it, they send you a bill. That's why I'm careful about it.
But you can get a form stamped by a French agency here. My assistant has been going down there every year. I can't even remember what it's in French and English. It's just to be able to demonstrate that you are actually contributing to the French Social Security system, and that's what is attached to self-employed, to be able to justify that you are contributing to a non-U.S. Social Security system.
Yeah, that's what that's what it says to do, the treaty, and that's what we did the first year when the treaty went into effect. But it was so difficult sending people on wild goose chases down to either the allocation familiale or one of the casts saying, "Could you please give me a stamped statement?" They had a bilingual statement, I think. And
it still exists.
It still exists. They also sometimes they would give you an attestation de filiation or something, but it was so much trouble doing that. Finally, I just attached a statement, like I said, and I've been doing that since 1988. And I've only had him come back once.
Saved me a lot of time there, Norman. If you had just told me that.
I've only had him come back once. I
never went myself. I always said to my assistant, I don't know what it is, just go down and get it stamped.
Yeah. But if you have somebody who will go down and do it for you, like Timothy.
She knows where to go now, so I don't even ask. That's why I
have
just
him do
it.
it.
Here it is, it's attached.
Well, basically, if you have a dependent, if you have a child, and you want to claim him or her on your U.S. tax return as a dependent and get an exemption, it's a deductible amount of $3,800, the child has to either be a U.S. citizen or a resident of the U.S., Canada, or Mexico, or an adopted child. If the child doesn't meet those categories, then you can't take an exemption for the child. You also have to have a Social Security number for the child. Although I guess an adopted child, you could have an ITIN.
It's not just if they have to be a U.S. citizen, but if they are the child of a U.S. citizen parent, you have to be able to justify. What people used to do is include children, and then suddenly when they required Social Security numbers for those children, A lot of children disappear.
Yeah, I was heard the Pied Piper walked through the land and millions of children disappeared.
We're going to have to just take one last question, I think, and because we're running over time.
The question is, U.S. earned income, you get a 1099 for it.
Okay, you're self-employed. You're self-employed. You're self-employed.
Yeah.
Okay.
Or I can go back to the U.S. for 3 months and work and get paid. Someone's going to give me a 1099. So how would I be declaring that?
Well, you have to fill out your Form 2555 correctly. And for the foreign earned income exclusion, it would not include the income you've earned in the U.S. from your work in the U.S.
You have to count the number of days, and it also depends the number of days. You have to be careful. You have to have supporting evidence for that, your travel times and periods, so that you can come up with. It has to.
Not with a self-employed person. You can just say, well, I earned this much in the U.S. Here's my 1099. That's not excludable.
But so it's on the form and I'm paying some tax, so I'm paying the U.S. tax on that amount.
No, it depends. You have to declare it all, unless you have a fixed base in the U.S. and a permanent office. You're domiciled in France, you're resident in France, and you're self-employed, and you work some in France and some in the U.S. It's all going to be taxable in France unless the U.S. income is coming out of a fixed base, an office, that's a permanent office you have in the U.S. If that's not the case, then it's all taxable in France. For the foreign earned income exclusion, we're trying to prevent double taxation on your U.S. return here now. You can exclude the part that you earned outside of the U.S., not the part you earned in the U.S. So on your Form 2555, you only can put, for an exclusion, the amount that you earned from working in France. In order to prevent double taxation on the amount you earned in the U.S., you have to use the foreign tax credit.
The question is, if you receive, if you're self-employed and you bill clients in France, that you put that on your French return. I suppose 2535. I'm not sure whether you're using a company or not. And if you bill clients in the U.S., that also goes. That's just part of your billing, but you include it on your French declaration. And you pay the French, and you then all of that should be excluded as foreign earned income because you're billing from France. The situation with this gentleman here is that he's actually doing work in the United States and billing it in the United States, but you're billing from from France to the United States. It just goes into your bilan. It goes into your, I suppose your 25.
Is that the case? All your work is performed in France? You work in France, the work is performed in France, you can use the foreign earned income exclusion against all of it. Monsieur Labat, he's working in the U.S. That's different.
Okay, well, thank you so much for coming.